Hi, I'm David Bush, Co-Chief Investment Officer at Trajan Wealth. I had the opportunity to appear on the David Lynn podcast where we talked about AI and how it's impacting financial markets. I hope you enjoy. Across the economy, we're experiencing a white-collar job collapse, but a blue-collar boom. Consumers are stretched thin, and we're seeing rising delinquencies and defaults in credit card, auto loans, and even some mortgage loans. The big trade over the last several years has been the Mag 7. All the hyperscalers. Now what we're experiencing is some CapEx volatilities. That build out of AI infrastructure is going to be a tailwind to the economy. And what investors need to look at is those sectors that are going to benefit from that AI infrastructure build out. So everything from
markets are not reacting well to the additional tariffs that Trump has implemented over the weekend. We'll talk about what that means for investors going forward and what it means for trade and the economy overall. Will we get higher inflation because of renewed tariffs, or is this the end of tariffs now that the Supreme Court has ruled against them last Friday? So far, intraday on Monday, stocks are down. The S&P is down about 1.5%. The NASDAQ is down about 1.5%. Bitcoin is down 3.5%. And we're going to find out what's next with our next guest, David Bush, co-CIO of Trajan Wealth. And he's been on the show before. Check out David's interview with me a couple months ago. Link down below. This video is brought to you by Kalshi. It's a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N. Link in the description, or scan the QR code here. New users will get $10 deposited to your account when you trade $10. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, in over 140 countries. David, welcome back to the show. Good to see you again.
Thank you so much for having me. I appreciate this opportunity, and good to see you as well.
You know, it's interesting. Right after Trump made the announcement Friday morning or Friday afternoon, midday, that he was raising tariffs, markets didn't move that much on the news. And I think I was speaking to another guest about this Friday afternoon. I said to him, hey, it looks like markets are thinking this is temporary, or maybe they're not taking this 10% hike very seriously. But here we are, the NASDAQ's down 1.5% intraday. So maybe there's something else going on, but perhaps we have renewed volatility and fear around trade. Which is it, do you think?
Yeah, I think it's a confluence of factors. So let's start with the tariffs. You're exactly right. The Supreme Court ruled that the global tariffs, the reciprocal tariffs that Trump instituted early on in his administration, were essentially null and void. And later that day, on Friday, he came out and announced a 10% globally, and then over the weekend, upsized it to 15%. And so that's part of it, is that we're seeing this increase in tariffs with all of our global trading partners. And he's doing this, I think, for a couple of reasons. One is to generate revenue, but also for trade policy, the trade policies that he wants to enact with some of our major trading counterparties. On Friday, the one bit of information that didn't get nearly enough attention that I think caused some of the volatility that we're seeing today is the inflation numbers came out, specifically core PCE. So when the Federal Reserve is setting monetary policy, their dual mandate is stability of prices and maximum employment. And the inflation metric that they follow is core PCE, which actually ticked up to 3%. And keep in mind that their target is 2%. So as a result, markets are now digesting, what does that mean for potential rate cuts into the future? And couple that with Kevin Warsh as the new Fed chair nominee, and what does that mean for markets?
One thing I'd like to highlight is that the Supreme Court ruling that occurred on Friday pretty much requires a lot of the tariffs to be refunded. So 175, up to as much as $175 billion, according to estimates, will be sought by companies. So basically, because the Supreme Court ruled that the regulation that the Trump administration used to collect tariffs was illegal per the justification, some of these tariffs have to be refunded, especially because tariffs can't be used to collect revenues per this particular rule, which is that it's only to be enacted during times of national emergencies. And so my question is, David, if we do get a mass refund process, are we looking at a boost in earnings, perhaps, or just blank checks to companies this year, next coming quarters?
Yeah, I think that process is going to take some time and will likely be caught up in the court process. So, one, you're exactly right that there's a concern that that the U.S. government has to refund $175 billion to importers, but with the new 15% global tariffs that he enacted over the weekend, what I'm wondering is will that help offset some of that 175 billion for those importers? And then what will be the legal process that they have to go through to get those refunds back? And I don't know the answer to that. And I think that it's currently being worked out. Like, how do they actually sue the government or pursue the government to get that refunded tariff money back? But it should be a little bit of a tailwind, kind of a one-time tailwind for any of the importers who were impacted by it.
But you're not using this as sort of a thesis to go long some of these importers?
No, not necessarily. And when we think about the U.S. government, our total GDP, and if we look at our treasury debt of 38 trillion, honestly, 175 billion is a drop in the bucket when we look at the massive size of the indebtedness of the government as it currently stands. So I don't think that this is going to be a massive tailwind for these companies. I think it's going to be almost akin to when we file our taxes individually and we get that refund back at the end of the year. We've already paid a substantial amount in taxes already, but there will be a refund process, is my guess.
Okay, and let's go back to inflation. So tell us a bit more about how you interpret the latest inflation numbers, and how do you think the Fed, importantly, is going to interpret the latest inflation data?
So the Fed has remained very data dependent, and they've reiterated that phrase throughout Jay Powell's tenure as Fed chair. And what that means is that they're observing the inflation metrics and unemployment metrics. And remember that the unemployment rate actually came down recently. And so when we look at that and we look at the data dependency, they're actually observing inflation data that has already occurred. So that data is already 6 to 12 months old. And now they're reacting to it. And any policies that they implement take another 6 to 12 months to impact the economy. So I think given the Supreme Court's ruling on tariffs, which should actually be deflationary in a lot of ways, plus the increase in services and home inflation, I think that the Fed basically has their hands tied. I don't know that they have room to cut rates. And in fact, the market today is pricing in only one rate cut for 2026 in September of this year.
Yeah.
The other side. Oh, go ahead. Sorry.
No. Go ahead. Sorry. Go ahead.
The other side of it is that Jay Powell's term as Fed chair ends in May, and President Trump has nominated Kevin Warsh, who has been a Fed governor in the past in previous career, but he also worked on Wall Street, so he's got a little bit of a market background plus that Fed governor experience. Now, what's interesting about Kevin Warsh is that he has historically been a hawk, meaning keep rates higher. But recently, he's talked about how AI automation should be deflationary. And so he thinks that there's going to be room to cut rates. But what investors need to remember is that when the Federal Reserve cuts rates, it's only the overnight rate that they're cutting. Everything else is supply and demand driven all across the term structure of the Treasury curve. And so what that means for investors is that front end will come down, but the long end is likely going to be supported to the other side of Kevin Warsh's thesis, which is he wants to shrink the balance sheet of the Federal Reserve, which means that supply, if you couple that supply plus any new Treasury debt issuance to cover our growing national debt, is going to keep those long end rates elevated. So if we zero in on mortgage rates as an example, 30-year mortgage rates are most correlated to the 10-year Treasury. We're not going to see in my opinion, we're not going to see mortgage rates come down significantly. It's only going to be that overnight rate.
Well, let's take a look at what traders think inflation is going to do going forward. So we've got the CPI in February. This is from Kalshi. It's a prediction market. And basically, traders are betting or predicting that you've got 88% chance that it's going to continue rising, at least by the order of 0.1%. So you've got, it has to basically by March, this trade closes out. What's your prediction?
Yeah, I think inflation is going to continue to come down. I think we're starting to see the impact of higher inflation and tariffs working through the economy. Consumers, and I think I talked about this on the last show that I was on, consumers are stretched thin, and we're seeing rising delinquencies and defaults in credit card, auto loans, and even some mortgage loans. So we're starting to see that come up. So the middle class now has to make a decision on what they're going to spend their money on. Are they going to pay their credit card and their mortgage, and are they going to continue to consume, or are they going to pay off debt? So they have these decisions that they have to make. So we're already seeing those deflationary pressures, and so consumers are starting to switch from higher price goods to lower price goods, and I think that's why we're seeing consumer staples do so well as a sector. And so we have tariffs. We've got the inflation and the monetary policy that has been in place that has started to lower consumer demand and business demand. So I think those inflation numbers are going to come down eventually. It's just, and then you couple that with AI automation. I think it's inevitable that it's going to come down, but it's just the waiting game. How long does it take for us to actually see it and observe it in the numbers?
And as an investor, how closely do you follow what the consumer does? In other words, if consumers pare back spending on discretionaries, do you do the same thing with your weightings?
Yes. So that's exactly right. So the consumers drive most of the U.S. economy. I think the consumer is responsible for somewhere of like 60 to 70% of the U.S. economy. And so if consumers start to pull back, and within specific sectors like consumer discretionary, then that sector should lag versus consumer staples, which are things that people have to buy, like food and just all the things that we have to buy on a weekly basis to support ourselves and our families. So we'll start to see that switch from higher price goods to lower price goods. You'll start to see that switch in retailers, like where consumers are buying. That's why we see places like Yum Brands is an example, which is Taco Bell, KFC, Pizza Hut. We have Walmart is another example. You'll start to see those stocks do well in this type of environment. Meanwhile, some of the luxury goods will continue to probably struggle.
And ultimately, the growth of the economy overall, U.S. GDP growth, Q1 in 2026, traders are predicting above 3% as the most likely outcome, which is basically saying that growth will continue, if not expand some more. What's your view?
I think it will. I think we'll continue to see that growth. There's so many tailwinds outside of consumers. If we narrow in, I mean, the big trade over the last several years has been the Mag 7. All the hyperscalers, we've seen those company stocks move up in price significantly. Well, now what we're experiencing is some CapEx volatility. So a lot of these companies have stated that they're going to spend hundreds of billions of dollars on AI infrastructure. Well, that build out of AI infrastructure is going to be a tailwind to the economy. And what investors need to look at is those sectors that are going to benefit from that AI infrastructure build out. So everything from materials, industrials, energy producers, utilities. And we're seeing that sector rotation now. And it's something that I've been talking about for the last several months is sector rotation and balancing those large cap tech growth names with value tilted companies that have the ability to support the AI infrastructure build out, because I think it's going to be a massive boom to our economy.
Okay, David, why don't we talk about how Kevin Warsh will impact fixed income? So you talked about the long end of the curve already, but specifically, what Fed policies do you think will be, I guess, put it this way, a little more bearish for bonds this year, if that's your view?
Yeah, so there's a couple of things that I would look at there. One is if an investor is in a floating rate instrument like a money market, or ultra short duration type investment vehicle, now's the time to step out the curve and lock in yields. So that 2 to 5 year part of the curve is kind of the sweet spot. Because what happens with the curve itself, when the Fed starts to cut overnight rates, the front end's going to come down. So everybody who is in that ultra short bucket, their yields are going to drop. Meanwhile, given Kevin Warsh's idea of shrinking the balance sheet coupled with treasury supply, that will allow for some stability in longer term yields. And I would say 2 years and out. And so now's the time investors can lock in those yields and essentially roll the curve. I mean, we're going to have a positively sloping yield curve. If we get 2 more Fed rate cuts, we're going to have a positively sloping yield curve for the first time in a couple of years, which from a bond guy's perspective is really exciting because you can buy the 5 year and roll down and roll the curve is what we call it. So lock in. The areas that I would be cautious in, I would be very cautious in high yield corporates. Right now, with credit spreads where they are at, I know that they've been tighter, but there can be some disruptions with some of these companies in the high yield space. So be cautious, do your due diligence, your own individual underwriting, if you will. IG corporates should do okay, but again, I would be very selective with any type of credit exposure that I'm adding to the treasury yield.
So we've talked about inflation. Let's talk about the labor market, the other side of the coin that the Fed watches. So I've heard on my show that actually the labor market isn't doing great. And in fact, probably the Fed pays more attention overall to the labor market just because it's a more direct signal of the health of the economy. Now, there was sort of a dissenting tone, quote unquote, in the last FOMC meeting when Christopher Waller said that basically he would have preferred a rate cut in the last meeting, which, as you remember, didn't occur. And he said this because he believes that net, the labor market didn't actually gain any new jobs in 2025 if you take into account all the revisions downward. And that's his view. And of course, we have the Fed actually go ahead and keeping rates unchanged. And so the unemployment rate, however, isn't skyrocketing out of control. We just have a different interpretation, I guess, of what the labor market strength actually is. What is your interpretation?
Yeah, so the labor markets are interesting because you're exactly right. The Bureau of Labor Statistics came in and revised the 2025 numbers down by, if memory serves, it was like 700 to 800,000 jobs. And really, this is a function of how the Bureau of Labor Statistics calculates these jobs. And the primary driver is they have an estimation function within their calculation of new jobs, and it's called the birth death rate. And it's not the birth and death of human beings, it's the birth and death of businesses. So if we go back to the COVID era, right at the beginning, remember all the PPP loans, there was all this money that was being funneled to US businesses. So there was a lot of LLCs that were stood up and they applied for these PPP loans, and there may not have been jobs associated with them. And so now we're still working through the aftermath of all the fiscal stimulus and really monetary stimulus that was enacted during COVID. And so this birth death rate function, and again, I don't want to call it a forcing function, but essentially it's an estimation of job growth, job creation, and layoffs, was really hijacked by that fiscal stimulus and the PPP loans. So now we're still working through that. In 2024, we saw something very similar where we had a massive revision from the 2024 job numbers. So I think they're still working through it. The other thing that I would look at is right now, it appears to me that across the economy, we're experiencing a white collar job collapse, but a blue collar boom. And what I mean by that is that that first rung of the corporate ladder is being automated in a large extent by AI. And we've seen that disruption across different sectors. We've obviously seen it in software, but now it's working its way through other sectors of the economy. And so what we're experiencing is that those candidates, those job candidates that have, applied for jobs, that entry level role just isn't there. Meanwhile, we've also seen some layoffs in some of these larger software developers because they're automating a lot of these jobs. So I think Waller's right. I think that his thesis of the job market's maybe not as stable as we would view it is actually pretty accurate if you just take a step back and look at what's happening, across the economy.
Okay. I guess if you were the next Fed chair, what would you be looking at most? What would you be doing and focusing on?
Yeah, I would be focused on jobs because I think AI automation is going to generally bring inflation numbers down, but it's also going to be disruptive to the labor market. When And so from that perspective, I would zero in on the health of the labor markets, new job creation, and what the impact of this AI automation is going to be long term. Now, on the other side of that, I think back to I'm old enough to remember working on an Apple IIe computer in a homeroom in elementary school, playing Oregon Trail. So, I was sort of conscious for the computer revolution of the 80s, and we saw the internet boom. And so there will be jobs created on the other side of this AI automation. And so for young people that are going into college or coming out of college, I think the key for them is to embrace AI, figure out how to use it as a tool, and be the key person within their company that understands how to use it and how to automate other processes. Because I think that's what's going to come out on the other side, and I think that there will be jobs created. On the blue collar side, I would really advise that this younger generation coming in to maybe think about the trades, the services. How can they get involved in this AI infrastructure build out? Because there's going to be a need for jobs all across the spectrum for this AI infrastructure build out. So I think long term it's going to be fine, is my point. But I think in the near term we're going to see a softening of the labor markets.
Long term, I'm not confident. Even blue collar workers are safe. Have you seen those robots that have come out of some of the U.S. factories in China recently? They're like doing flips and doing kung fu and stuff. I don't think it's difficult to program at this point a humanoid robot to do your plumbing if they really so wanted to.
It's interesting. I have a friend that manages a hedge fund here in Scottsdale, and he just bought. I think the robots. I don't want to give him a commercial, but there's a home robot that actually looks like almost like a humanoid.
Yeah.
And the plan is, I think it can carry like up to 150 pounds, but the plan is to program them to do things like fold laundry, mow the lawn, some of these other tasks, and will automate some of these things as well. I think so. It's interesting. We're in a pivotal time in the history of not just the United States, but really of the world. It'll be interesting to see how this plays out over the long term.
Are you placing bets on robotics yourself?
So what we're doing, which is this is really kind of interesting, is when you think about AI build out, you have the large language models, you have the chip designers. They're going to be fine. They're going to continue to improve their designs and the large language models. What we're faced with right now is a resource war, specifically with China. And I think that's been a lot of what's driving the geopolitical landscape and why Greenland was such a hot topic, because those rare earth minerals are required to build this infrastructure out. And China has, I think they control, it's like 70 to 80% of the rare earth minerals that are out there. What's interesting is, and this is fascinating to me, I've been researching some companies. These are all pre-IPO, so these are not publicly traded. So apologies, but it goes to your question. There are companies that are building robotics that can disassemble an existing server stack. And then they have another company that can essentially monitor if it's coming across a conveyor belt, all of the different components, and can point out which of those components is what rare earth minerals. And then a third company is coming in and refining it so that it can be recycled and reused. And so I think this is all kind of the wave of the future in terms of how we're going to supply rare earth minerals. But also that key is the robotics side of it, because it can identify which of those key elements are within that disposal. And what I find most fascinating on this is that there's already partnerships that are being developed with landfills and waste management companies to disassemble the phones and the laptops and the CPUs that we've thrown away, that can then go in and find some of these materials. And it's just a fascinating space for me to research. But it's being funded by the Genesis mission, which was part of the Big Beautiful Bill Act. So there's actually U.S. government support behind it, because there's a recognition that we need access to those rare earth minerals.
All right, Iran war. Let's pivot to that, the Middle East region overall. I think it's been speculated that it doesn't matter if a deal is reached imminently or not. The amount of force posturing in the Middle East right now, which is, by the way, the biggest buildup of the U.S. military since the Iraq War in the Gulf. The United States doesn't send an armada of that size if it just wants to flex its muscles. There's going to be a strike at some point, is the analysis. What does that mean for markets?
Yeah, it appears so. And I think President Trump has given Iran 10 to 15 days to sign a nuclear agreement. And if not, then there could potentially be a hot war. Now, how that translates into markets is we'll see the price of oil go up, so the cost of energy to go up. It'll also be a disruption, just cause volatility across sectors. The sectors that should benefit, and I hate to even think that way, but if we look at every single war that at least in my lifetime, it's the defense contractors, the military suppliers. I think oil producers will do well, because if it causes the price of oil to go up, that means that even if you have West Texas Intermediate that you're drilling, the price of that barrel of oil is going to automatically go up, because global supply would come down. So there's going to be some winners and losers, but in terms of those sectors that will do well, it's those that I just mentioned.
Okay, and are you long oil at this point? I mean, if you take a look at the oil market right now, it doesn't look like people are really worried about what's going to happen. Actually, if you take a look at how oil's performed, it's up about 8% since a couple of days ago. But I mean, that kind of a move is not, entirely new to oil. So it's still trading in the 60s, right, per barrel. And either the oil market doesn't think there's going to be a hot war, or it's already priced that in. And ultimately, it doesn't matter that much. What do you think?
Yeah, I think it's likely already priced it in. I mean, the U.S. government's been sending ships. The Armada has been, we've been reading about this for a couple of weeks now. And so what's already happened is that it's priced into the markets. So oil drillers, refiners, they should do well. We also have to consider the government actions in Venezuela, because that's the largest proven oil reserves in the world. And it's right there close to the Gulf Coast. So you can see a scenario where the U.S. helps rebuild the oil drilling capacity there in Venezuela, and then ships that over to the Gulf states for refining and ultimately shipping across the globe. So I think the oil markets have already priced a lot of this in. And just if you kind of take all the geopolitical events that have happened recently, it's likely already priced in. Thank you for watching. Be sure to like and subscribe, and let us know what you think in the comments below.